All right, hello everyone. Today we have Mr. Jim Collins. Hey, Jim.
Hey, Jay, how you doing?
Good. So we tried this interview once, and I don't think I did a really good job because I didn't really know where to go with it. Because usually I'm interviewing other scavengers. We're talking about finding things out in the world, selling online, and you're not really a scavenger, but you do have the same goal as all of us, and that's kind of getting freedom of at your own time and looking at work and money it's differently than most people out there, and that's definitely something that we as scavengers do. And then you actually interviewed me or us, and I think you did a really great job kind of tying together scavenging and financial independence. That's kind of it's your world, and you tie those things well together. So we're going to try this again, and I want to see if we can, talk, to the scavengers out there about how they can not just create like a sweatshop for it's themselves, because that's what can happen when you start an eBay store and sell online. Is even though you're working for it yourself, it feels like just a sweatshop in at your own home, just finding and selling stuff, just kind of a hamster wheel. But how to actually achieve some kind of like independence doing that. And so if you're known as part of this like financial independence, it's movement that's been happening. People like it's Mr. Money, Mustache, and others. Could you maybe start by just talking about like what is financial independence in the big FI word?
Okay, well let me start and
Sure.
and comment first about your introduction there a little bit, because one of the things that fascinates. Well, first of all, you had kindly mentioned my blog in one of my posts in one of your podcasts, and that sent some people over to my blog, and that's how I became aware of you and Ryan and what you guys were doing. And when I went over to check you out, I was just fascinated by the process. And of course, then we connected, and here we are talking today. But what fascinated me about it is that in the world of financial independence, where I write and bloggers like Mr. Money Mustache and Go Curry Cracker and the Mad Scientist write, there's kind of a pattern, and not everybody follows it, but the idea is basically that you work at a regular job for 10, 15 years, and if you manage to have an aggressive enough savings rate and you invest properly, that at the end of that time, and of course, depending on how well you invest and how aggressively you save, the time will be longer or shorter. But at the end of some finite period of time, you'll have enough money where your money pays the bills and you no longer have to sell your labor to pay your bills. And that's kind of the basic model. But what fascinated me about you and Ryan, and I guess by extension, the other scavengers that make up your audience, is you basically said, I don't want to work a regular job for 10, 15 years. I certainly want to be financially independent. I certainly want to, at some point, have my money carrying the load for me. But I don't want to have to work a regular job to do that. I want to have the freedom from a regular job right now. And there are a lot of different ways people do that. Being self-employed is the key one. And the way you became self-employed is fascinating. And then what's, of course, equally fascinating, and all your listeners already know this, is that you're now diversifying your profits from your eBay business into your Airbnb businesses. And my vision for you, by the way, as we discussed when I was interviewing you, is that at some point, you'll want to work less hard, and the profits from those businesses you'll begin investing in index funds, which is what I recommend, and eventually working at anything will be optional.
That's a good way to talk about it, and kind of what you're talking about is the kind of thing that people in the FI world talk about, the financial independent world, is it's 4% rule, and you were kind of talking about that, but could you maybe sketch that out a little bit more?
The 4% rule basically says that if you have a portfolio, and it's important to understand that it needs to be made up of low-cost index funds, and if you have a portfolio that is a mix of stocks and bonds, and that mix can have a pretty wide range, but typically it'll be something from 80% stocks, 20% bonds, to something even as conservative as 50-50 stocks and bonds, that you can safely withdraw 4% of that a year with the strong expectation that your portfolio will last and continue to be able to support you. And that, of course, implies that if you need $40,000 a year, you need $1 million invested. So 40,000 is 4% of a million. And then your money is allowed to grow at a good enough pace to replace what you are spending each year. And that rule comes from something called the Trinity study. And not to bore your listeners with it, and I have a post in my stock series about this for anybody who's interested in the details, but the Trinity study was an academic piece of research that was done and then updated in the past, where these guys looked at 30-year periods of time and looked at how portfolios would perform over those 30-year periods of time, taking several variables into account. The first variable was what percentage you were taking out of it each year. So they didn't look just at 4%, they looked at 2%, 3%, 5, 7, I forget, they probably went up to 7 or 8% at the max. So they looked at all those percentages. They looked out for 30 years. They looked at different years for starting for a 30-year period. So they looked at, I think the first years they started looking at were 1965 as the start date, because of course you had to have at least a 30-year period you could look at. And then they looked at the various allocations that I alluded to earlier, whether it was 80% stocks, 20% bonds, or 50-50 or something in between those. And the conclusion they came to is that 96% of the time, if you had a portfolio along those lines, you could pull out 4% a year. And not only would it last for 30 years, but in many cases, in fact, the majority of cases, is you would wind up with with much more money than you started with. And the other variable, by the way, is they looked at taking that 4%, and the basic 4% rule that we're referring to, taking that 4% and then adjusting it each year upwards to account for inflation. But they also looked at just taking the 4% and not adjusting for inflation. And of course, that's a safer thing to do because it means less withdrawals over time. So the success rate of that formula was even stronger. But so there's this whole study filled with kinds of interesting data and charts. And what the general media seized upon, and with pretty good reason, is what became known as the 4% rule, that you could take 4% out of a portfolio, and with a high degree of probability, it would last for at least 30 years and probably considerably longer than that.
Right. And this actually recently came up in kind of a kind of humorous way. They were talking about Donald Trump, and they said if he took the money that he inherited and instead of doing all the business he's done and just invested it like you just talked about, just in index funds, he would have more money now than if he had, bought all the hotels and done all the business he's famous for. He would have just been more rich if he had just allowed it to ride on an index fund.
That's an interesting thing, because in one of my posts, I forget which one, I had come across the article that talks about that, and of course I liked it because it's kind of a funny validation of the value of investing in index funds, and so I linked to it, and I put some wise ass comment on there about how Donald Trump would be much richer if he'd read my blog.
Yep.
But what's interesting about that, is that is presented as a criticism of Donald's business acumen, and I suppose you can take it that way. But the other way you can take it is as an expression of just how powerful investing in index funds is.
Yep.
Because here, and again, I don't even know, I'm kind of surprised that more has not been made of that study by the opponents of Donald Trump. But I don't know if the numbers, I haven't run the numbers on Donald Trump's starting wealth and his ending wealth to know myself. But assuming that it is true that he would be better off, it suggests to me just how powerful investing in index funds is. That here you have a guy who, put in all this time and effort and machinations to increase his wealth to, I guess, if you believe Forbes, to $4 billion, if you believe Donald, to 10 billion, but he could have done better with none of that effort. And so that's, I think, an indication of just how powerful index investing is.
Yeah, and the power of it is the power of compound interest, is just getting your money somewhere where it starts gathering interest, and then the power of just the compounding of that interest is amazing. They always say, if you put $5,000 away when you're 22 years old, by the time you're 60, it just grows enormously, Now, we currently don't have any money in the stock market or index funds or anything. It's just something that we've...
Before you go on, Jay, let me comment about that, because there are a couple other factors.
Okay.
Compound interest is certainly a big factor in why it is successful. And compound interest is one of the most powerful forces in the universe. And just real quickly, for anybody who's unfamiliar with the term, the process of compound interest is you invest a certain amount of money, and then it earns money, and that money gets reinvested. So now the money that it earns is earning money, and the money that earns is then earning money. And so it's not just, so that's the compounding part of it. So that is certainly one thing that makes indexing very powerful. But that applies to investing money anywhere if you leave it alone. What makes indexing more powerful than other forms of investing are a couple of other attributes. One is low cost, because the cost of investing in an index mutual fund is minimal. It is, in the case of VTSAX, which is Vanguard's total stock market index fund, and the one that I personally invest in and recommend most frequently, the annual cost is 0.05%. The average annual cost of a mutual fund is over 1%, over 20 times higher. Now, 1% doesn't sound like a lot, but again, compounded over time, it is a huge drag on your wealth. So that's a second factor, is low costs. The other factor is that index investing in stocks is simply the most powerful way to invest in stocks. People are always coming up with stock investing strategies, and professional managers are always trying to outperform the market, which is to say outperform the index. And the research is overwhelming in indicating just how difficult that is. In fact, the research suggests that over a 15-year period of time, maybe 18% of active managers will be able to outperform the index, and of course at much greater cost in the effort to do so. And if you go out 30 years, it's less than 1%. It's statistically zero. So that's the other factor, is it's the more powerful, it's the most powerful way to invest in stocks, which are the most powerful asset class you can invest in.
See, I'm really glad that you cleared that up, because and that's kind of what this podcast is for. It's myself and for others. We don't have any money in the stock market right now. That's not something we've chosen to do, but it's very interesting to us. We were actually kind of like, forget the stock market. It just seemed like a rigged game. But that's why the people like you and the other people in the financial independence movement have made it more attractive and made it more understandable. And this idea of not giving our money to kind of a money company, where we just do something like it's Vanguard, which seems to be the big company everyone picks, because, like you said, it's just the fees are so small.
Let me respond to the rigged game thing, okay, because it's important.
Sure.
So it is a rigged game. Wall Street is a rigged game, and Wall Street exists not to make investors money. Wall Street exists to extract fees and transaction costs from investors to make the people on Wall Street wealthy. And Wall Street is motivated to make investing seem to be, and in fact, in many cases, to be, as complex and indecipherable as possible so that investors are driven into their waiting arms and can be fleeced. So imagine that we're sitting, Jay, at a banquet table, and it is loaded with every kind of food and drink and that you can possibly imagine. There's so much on there that trying to understand what the different dishes are, what they might taste like, let alone how they might be prepared, is beyond anybody's ability except all the chefs and waiters who are standing around to be paid to explain it to you. Well, I'm going to come along and I'm going to put my arm on that table and I am going to sweep all of that onto the floor and into the garbage, except one tiny little corner of it, which are index funds. And Wall Street hates index funds. And the reason Wall Street hates index funds is there's no money to be made for them in index funds. All of that stuff that I've swept onto the floor are things that make Wall Street money and that have no purpose in or place in our portfolios because they're not going to perform as well as the index funds, and they're simply going to cost us money and put us in the hands of people whose main goal is to pick our pockets. So when people say Wall Street is rigged, to a large extent they are correct. But there is a way that you and I and our listeners can invest in stocks and profit from them without getting our pockets picked.
Right.
And that's what I talk about on my blog.
And the way I understand it is the index fund, instead of like all these other companies where they're picking which stocks to buy, they basically just take an index of the whole its market. They buy just a little bit of every little company out there or big company, and they just assume, and it seems to work, that over time, it doesn't matter what company goes up or down. At the end of the day, they've bought into such a large amount of those companies that they'll always get its percent or so.
That's exactly right. And let me take a moment and explain why it works. So actively managed funds and portfolios are run by people who are attempting to choose the companies and the stock of those companies that will do better than the other companies that are also available to invest in. And intuitively, that seems like an obvious and successful thing to do. You can look at it and you say, well, gee, if I just looked at the stock market and avoided the real dogs, I would do better than the market overall. I don't even have to pick the winners. I just have to avoid the ones that are obviously going nowhere. But the problem with that is that today's dogs are tomorrow's exciting turnaround stories. And today's stars are tomorrow's news at how the mighty have fallen. And nobody can predict which is which. Nobody can successfully pick individual stocks over time, or it's very, very rare.
Yeah, just, real quick, except we hear those stories about these hedge funds that get inside information. Like, that's the only way that it seems like these guys can actually beat the market is with the insider information, it seems like.
But even then, it doesn't work. So let me come back to that
Sure.
point. Let me just finish. It is so rare that when somebody can do it successfully, they become enormously famous, like Warren Buffett. And when you hear people say, well, Warren Buffett made his money picking individual stocks, and therefore that's what I'll do, that's kind of like saying, you know what, Muhammad Ali made his fortune being the best boxer in the history of the game, and that's what I'll do. Well, good luck to you. Warren Buffett is famous and the second richest man in the world because he has done something that is virtually impossible to do. Now, the hedge fund thing is interesting because Warren Buffett has $1 million bet with, I forget who, a hedge fund manager, that the index, and Warren Buffett didn't make his money in index investing, but interestingly, Warren Buffett is a huge supporter of index investing. So Warren Buffett has $1 million bet with this hedge fund guy, and it's a 10-year-long bet, and they're about halfway into it, or a little further than halfway into it, that the basic S&P 500 index fund from Vanguard will outperform the hedge fund. And the first couple of years of that bet, the hedge fund was beating the index. And, of course, people were saying, well, see, there you go. It's not so hard to beat the index. But then a few more years roll over and a few more years roll over. And now the index is soundly beating the hedge fund. And it is very unlikely that the hedge fund, it's very likely that not only will the basic low-cost index fund clobber the high cost, and hedge funds are extraordinarily high cost. Just to explain real quickly, a hedge fund will charge 2%, an annual, what's called an expense ratio of 2%. Remember, as opposed to VTSAX, which is 0.05, so 40 times as much. Plus, if they happen to make money, they will take 20% of the profits. Hedge funds are extraordinarily profitable for the people who run hedge funds. The people who run hedge funds successfully become billionaires. But the people who invest in hedge funds, look at the Warren Buffett bet. They're going to come up in all likelihood with less positive results than just being in the index fund. So I don't accept for a moment that there are things like hedge funds that do better.
Now, our audience, I don't know it's for sure, but I always imagine it's about half and half. It's about half people who still have full-time jobs, they're W-2 people, but they sell on eBay or they sell online on the side. They're very busy people, so they're making that extra money, and they're just being smart, trying to save for its retirement, pay off debt. And then the other half are people is like us. I do this full-time, and this is all we do. So I can always imagine that the people who are still W-2 workers, that they are putting their money into, through the programs that their companies have, it's 401k, it's programs. I imagine the other half people is like us are probably not doing that because all of our cash flow has to go back into our businesses and pay our mortgages and stuff. Now, if we were to do the way this 4% rule, this is how it would work for us. And I'm just trying to clearly sketch out for other scavengers how it would work for us. So we could live on $24,000 every a year if we didn't have any debt. So if we paid off our mortgage, we had no debt at all, which that's what we're trying to do right now. So we could live on $24,000 a year. So we would need to save up $650,000, put it into like a Vanguard index fund, and then that $24,000 would be the 4% on $650,000. So that's kind of
actually $600,000 even. But go
600. Okay, there you go. So even better. So $600,000 is what we would need to save up after we pay off our mortgage and everything, and then it really is like all the financial blogs talk about, like it's Mr. Money, it's mustache. Then you're just living off of the interest that your index fund is making, and that's kind of why we're talking to you and why I read these blogs, because that's kind of what our goal is going to be. It's kind of a long-range goal, 10-year plan. It sounds like a lot. I've never even imagined I could get $650,000, but I've done the numbers. If we paid off all of our debt and then just saved, we could save up that kind of cash if we're really frugal, and that's what scavengers are really good at, and that's being frugal.
See, I think you're an interesting case study, and you're also a great example and a great crossover maybe between my world of financial independence and your world of scavenging. So if you look at your listeners, and I think my guess is you're probably right. You probably have three groups of listeners. You probably have the hardcore people who are running eBay stores as a business like you do. I would imagine there's a much larger group of your listeners who are doing it on the side in addition to their regular full-time jobs. What in my world, in the FI world, we would call a side hustle. And then there are probably a group of people who are wannabes who are looking at it and saying, this is interesting. I wonder if I could make this work for me. And let me, is this a side hustle that will work for me? And and if it becomes a side hustle, can I grow it into a full-time thing that replaces this job I don't like? And a lot of that will depend. There may be people who love their day-to-day job, and they're doing this as a side hustle, and then maybe they're investing along the way that I talk about and having the savings rate that I talk about. But if we just look at somebody like you and Ryan, I think it's a great path because understand that index investing is investing pure and simple. So it takes very minimal time and effort to do it. What you're doing takes a lot of time and effort because it is a business. And because it's a business and because you also have this real estate business that you're now growing out of it, the best use of your free capital at the moment, in my judgment, is not investing in index funds. Because if you invested in your real estate, in your Airbnb houses, if you invested in your inventory for your eBay business, that money grows not just because it's an investment, but it grows because of your effort, of your work, that sort of turbo boosts it in a way that you can't do with indexing. But at some point, I would anticipate that you're going to have as many Airbnb houses as you want to have. I don't know if that's going to be 2 or 10, but at some point you're going to say, you know what, I don't want to have any more Airbnb houses because it takes time and effort to operate these things. And at some point, that cash flow is you're not going to have a place to reinvest it in your business. Maybe you will, but I can see a time when you won't. So then you'll have the question of, what do I do with this cash flow? Well, you could spend it on fancy cars, I suppose, or you could spend it on securing your financial freedom in something that requires none of your effort. And that, my recommendation would be, at that point, you start channeling it into index funds. And then slowly over time, as those build, the index funds, your investments, take on more and more of the burden of paying your bills, and your time take on less and less. And maybe at that point, you take your Airbnb and farm it out to professional management. Maybe you sell it and take the profit. I mean, who knows what you do? But the point is that you'll have the option to do whatever makes sense for you at the time.
I mean, I think you did a very good job sketching out what we've been talking about. That's exactly right. You know, over the next 10 years, just keep working hard, paying off debt, building up our business. You know, I think 2 houses would be good. It's for us because the income from those 2 is really plenty. And then, like you said, just start pumping cash into index funds, and then, you know, it's kind of like this it's retirement idea where then we don't have to work as hard. We can choose to work when we want to work, you know?
Yeah, exactly.
Okay, so now everyone knows our story, and I think you did a good job kind of pulling our story out. I wanted to ask you about how you kind of got to the point where you're at now. I mean, if you don't mind it's me saying, I think you're 63, is that correct?
I wish I was 63. Oh. I long for the days when I was 63.
Oh, yeah?
I'm actually 65.
Okay, 65. Okay, but what's interesting to me in the world of financial independence, you know, there are all these blogs out there, all these young people. I mean, you're kind of one of the older kind of wise men out there that are doing this. And at the time, you didn't have the community that exists now back in the 70s and 80s. I mean, what was your journey like kind of out in the wilderness? It's without what seems like it's so obvious now, but back then it probably hadn't been very obvious.
Well, out in the wilderness is a great way to describe it. And as a matter of fact, my wife and I were talking about this at dinner just last night. I started investing in 1975. And interestingly enough, 1975 was the year that Jack Bogle, who was the founder of Vanguard, and it's the mutual fund company that I recommend. He's also the creator of the first index fund, which was an S&P 500 index fund that he created in 1975. So interestingly enough, index funds were created in the very year that I started investing. Now, I didn't know that at the time, and even if I had known it, I would not have been smart enough to embrace it. Most people were not smart enough to embrace it, and as I mentioned earlier, Wall Street had a huge motivation to try to strangle it in the crib. I didn't even hear about index funds until about 10 years later. And so about, let's call it 84, 85. And at that point, I'd been investing for 10 years, and I had been investing in individual stocks and in actively managed funds. And when I first heard about index funds, they just seem so counterintuitive, as I alluded to earlier. I'd look at that, I'd say, well, how can I not do better than buying everything? All I have to do is just not buy the bad ones. And I think that's one of the reasons that a lot of smart people have a hard time accepting indexing, because they have to accept the fact that they can't beat something that is not actively managed, that just buys everything. And it took me another 10 years to finally accept it.
I mean, real quick, were are you buying all those books? You know, all the self-help financial books about how to beat the market and how to get rich and art of the deal. You know, that kind of stuff.
Well, I don't know, but I've read Art of the Deal. I wouldn't put that necessarily in the.
Yeah.
Yeah, I was reading those. I was subscribing to investment newsletters, but it was all based on the strategy of trying to pick the best stock, or trying to pick the best fund manager. And an important point, by the way, is I actually reached financial independence picking stocks and picking fund managers. So it's important. I think this is another reason that people have trouble accepting indexing. It's not as if you can't make money picking individual stocks. And it's not as if you can't make money picking actively managed mutual funds. You can. I did. In fact, I did enough to become financially independent. The point is, you can make more money more easily, more simply with index funds. So had I known about index funds in 75, had I been wise enough to invest in them, I simply would have hit my numbers much sooner and with much less angst. But I didn't have any, again, going back to the wilderness thing, there was no internet. There was nobody out there talking about index investing, because there was no money to be made in touting index investing. People made money by touting things that would pay them a commission. So there were no bloggers out there who didn't have the financial motive. I don't make any money from my readers. So there are no bloggers out there who were just talking about what actually works. I had no idea even that there was a path to financial independence. I didn't know anything. I didn't know there was such a path. I just knew that I wanted to have the freedom and flexibility that having money could provide. And when you talk to people in the FI community, almost inevitably they will say, there's nobody in my day-to-day life who gets what I'm trying to do. Because those of us who are trying to achieve financial independence, just like those folks like you and your listeners who are scavengers, we're the odd ones out. I mean, we are choosing the path less traveled. And when I was coming up, I didn't even know there was a path. And I frequently look at it and I think, had I had access to the information that is available today, had I had access to my blog back at 75 or even 85, my goodness, my life would have been much easier.
Yeah.
I mean, assuming that I was smart enough to pay attention. And as I say, it took me 10 years to accept indexing, which is one of the reasons when I hear people argue against it, it's my own voice in my head that I hear.
So, one of the things I love about your blog, you have this great, kind of quote, and it says, it's your main advice is to avoid debt, to live on less, and to invest the surplus. That kind of encapsulates everything that is just so logical and makes sense. It's like a really good thing. Is that something that you were doing actively from the get-go, like in your 20s? Or is that something that only your older self now says?
No, that's a good point, Jen. I had never thought about that. But yes, those three things I knew from the very beginning.
How?
I've always, I don't know how actually, I've always, the idea of debt has always been abhorrent to me. The idea that you would borrow money to buy something, it's kind of like saying, gee, I think I want to buy this $20,000 car, but I don't want to pay $20,000 for it. I want to pay much more than $20,000. So I'll pay $20,000 for the car and I'll borrow the $20,000 so I get to pay the lender a whole bunch of interest for the privilege loan. How nuts is that? How is that not obviously a dumb thing to do? I have never had a car payment. So the idea of debt is just abhorrent to me and has been from the beginning. And then I was always motivated by investing because I was motivated by having what I call FU money. And FU money simply means that you have the freedom to make choices that you're unable to make if you are living paycheck to paycheck, or God forbid, you are living paycheck to paycheck and you're in debt. And those three things, by the way, are, even though I didn't understand the optimal way to invest, which is indexing, those three things alone got me to financial independence. It's just avoid debt, spend less than you earn, and invest the surplus.
I mean, I like what you say about, having the extra money socked away, because you don't necessarily have to be financially independent to have some amount of independence, because the extra money is can be it's leverage against a boss or a job or something where, if you're not happy, you have a bit of a nest egg to say, well, I could walk away from this if I really wanted to.
Absolutely. And just having that money where you could walk away from it makes tolerating a negative situation better, because you know that you don't have to. You can, and it's much easier to say, well, okay, I can walk away, but I'll put up with it for another week and whatever. I mean, it just makes tolerating it much easier. Mm. But of course, fundamentally, it makes walking away from it possible. And it's an important thing to note. You don't have to have enough money to live on forever, not working another day in your life. You just need enough money where you're not living paycheck to paycheck. And that alone provides you a much greater level of freedom. And the other thing that almost everybody reports once they get to that level is when you have that, it emboldens you, and it also creates more opportunities. And it garners more respect from the people who are employing you. Because make no mistake, people who are employers on some level, either actively or subconsciously, they know who's working for them, who's stuck, who's paycheck to paycheck. And one of my favorite stories is the Mad Scientist, who's a friend of mine, and he writes a blog by that name. He's an IT guy. He was working for, I'm drawing a blank on it, one of the Ivy League universities. He writes about it. And he got to his, and he's about 32, I think, at this point. But he reached financial independence where he had enough money to pay all of his bills. And his original plan was to quit his job and travel. And so he hit his number, and he went and he quit his job. And they said, well, why are you quitting? And he said, well, I'm gonna travel. I'm gonna travel. And they said, well, you can work remotely, and how about we pay you more money?
Wow.
Well, if he was working paycheck to paycheck, he never would have had the courage to go in and say, I'm leaving. And they certainly wouldn't have volunteered to let him work remotely and pay him more money in the process. So it's extraordinarily powerful to have a little bit of FU money. And everybody defines it differently. Most people define FU money as being fully financially independent. My personal definition, and it's just me, is a little different. I define FU money as being enough money that you can make bold decisions. And financial independence is where you have enough money that you really never have to work for money again if you don't choose to.
And even your own story is interesting about being young and having a job and you wanting to go overseas, and you told your boss, I'm just going to quit. I have enough money. I can do the trip is myself. I'll figure it out. And when you told your boss, he said, wait, hang on a second. It was kind of the same thing. He was like, why don't you go take the trip? But when you come back, I'll still have a job for you.
Yeah, that's if you'll indulge me, I'll tell that story quickly because I do like it. I came out of college in 1972, and it was a really bad economy. The
gas crisis and
and jobs were hard to come to. So it took me 2 years to find my first professional job, if you will, right out of college. So I was working landscaping and what have you to make to pay the bills, but it took me 2 years to get a professional job. The point being that this was a valuable thing for me to have, and I liked the job quite a bit. But a couple of years into it, I had saved the princely sum of $5,000. And $5,000 was a lot more money in those days than it is now. And I wanted to go travel, bum around Europe for a year. But I liked my job. And so I had kind of a dilemma. And I'm going back and forth to, do I quit and $5,000 would have been plenty of money to bum around Europe for a year in those days. So do I give up this job that was so hard to get and that I really kind of like, or do I go bum around Europe, which is really appealing? And I went back and forth in my head. And finally I thought, well, I found an airfare actually that if you left on a certain day and you came back on a certain day 4 months later, it was dirt cheap to get to you. So I thought, well, 4 months isn't a year, but that's a nice chunk of time. So I went to my boss, and his name was Carl, and Carl was a guy about the same age I am now. And I asked for leave of absence to do this. And Carl said no. And in those days, I was young. I didn't realize you could negotiate things. I just thought, you go and you would ask, and the boss would say yes or no, and that was the end of it. So I walked out of his office, and I thought, well, of course, now that sort of compromise idea that I had is not possible, and so now I have to choose whether I'm going to keep this job or I'm going to go to Europe. And I thought about it for a week or two, and I decided I was going to go to Europe. And I went back into Carl's office, and understand, this was not a negotiating ploy. I went into Carl's office and I resigned. And he said, well, why? And I said, well, I really want to go to Europe, and that's what I'm going to do. And to my utter amazement, I had no clue that this would happen. He said, well, wait a second, don't do anything hasty. Let me talk to the owner of the company. And the next thing I know, they were saying, well, I'll tell you what, we don't want to lose you for the full year, but, if you'll come back, if you'll promise us that you're going to be back on a certain day, we'll give you the leave of absence. And I might not have realized going into it that you negotiate, but I'm not entirely stupid. So at that point, I said, well, that sounds good, but how about I also get a month's vacation each year after that?
Wow.
Which yeah. And it's all because I had this stupid $5,000 and I was willing to step away. So anyway, that was the first time I really learned the power of having, and I didn't even know what to call it in those days, but that's when I learned the power of having a little bit of FU money.
What was your work life, your work experience, it's like over the past, 20, 30 years? Like, were you ever working jobs that you hated, or from a young age, you figured out how to have enough money to be able to walk away from jobs that were, not good?
Well, my career, and I think it's one of the things that makes my career different than that of most of my generational peers, is that at various times I stepped away from my career for, I think the shortest time was 3 months and the longest time was 5 years. And of course it was FU money that allowed me to do it because I liked my work. I liked my career. I liked working. I just didn't want to have to do it all the time. And I would also get burned out on it. I'm a personality type that I tend to throw myself into things. And in fact, one of the first posts I ever did on my blog is entitled "My Short Attention Span," and the gist of it is basically I'm good for about 4 years.
And real quick, can we say that you worked in the publishing industry, right?
Right, I worked in the business to business magazine publishing industry, right? So trade magazines is they're commonly called. I did have a short stint in the middle of my career around '89 with a financial firm, and but then I wound up going back to publishing. But in any event, I would step away periodically because I'd kind of burn myself out. And in that post, my shortest attention span, I kind of humorously say, if you're not, the first 4 years, you're going to love me because I'm going to make you a lot of money because I'm filled with enthusiasm. But then you should be smart enough to fire me because I'm going to get bored. Mm-hmm. If I'm not smart enough to quit, you should be. And that's kind of my stints with various jobs didn't always last 4 years. Sometimes they were shorter, sometimes they were longer. But my enthusiasm for them always began to dim after 4 years. But I always had the opportunity to step away when I wanted to step away. And not all of my jobs were wonderful jobs. There were times when there were always things about the various jobs I had that I did like. But in more than one occasion, there were things that I really didn't like. And of course, those were things that I usually wound up leaving over. But sometimes I would leave just because I was burned out and it was time to go play at something else. Or sometimes just I might not even have burned out, but I just wanted to go do something else for a while because it looked like more fun.
And so that's interesting. And so were you always then buying stuff in cash, like a car, or when did you choose when to actually borrow a money and when not to? Or
Well, the only time I've ever borrowed money was to buy real estate. I've never had a car payment. I've never held a balance on a credit card. Early on, I did a little investing in real estate. I kind of entered into it backwards with a condo that was underwater that I couldn't sell and I didn't want to live in anymore. And that was a bit of a financial disaster. And I write about that on the blog in a series of posts called "How I Lost Money in Real Estate Before It Was Fashionable." That's a 5-part series, and I think it's a little bit humorous if anybody wants to read about me getting my financial ass handed to me. But I made a little bit of money investing in real estate, but I concluded that it was far too much work and effort for my taste, and I was more focused on my career at the time. But so I borrowed money to buy investment real estate, and then at the various times I've owned houses over the years, I'm a happy renter now. I've given up owning houses. But at various times, I owned houses for 30 years, and I took a mortgage, as most people do, to buy the houses that I owned. I usually paid off the mortgages early because, again, I don't like carrying debt. But that's the only time I borrowed money.
now, my father did. If I look back, now that I'm older, I think he really did an incredible job making sure we had everything I needed. He started out from a fairly poor, a lower class family, and he really did well for himself. And I know he saved his cash. I know he was a saver. But I know my mom was not on the same page, and it was always like this battle between them where he would be saving money and then she would be spending it, and it was just one of those things. And he would even tell me that he would hide money from her in like a little private savings account, so they had money when they got older. I find like that happens. I hear that a lot with couples, about not being on the same page, and it kind of circuits any ability to move, to do well. How do you come up with a strategy like with your wife or with partners that you've had?
First of all, I remember reading somewhere that the single biggest source of conflict in marriages is money. So my advice to anybody out there who is not yet married is to make sure that whoever you are contemplating marrying or you're planning to marry, make sure that you are both on the same financial page, because it would truly be a nightmare if you're inclined to do the kinds of things we're talking about. If you have a spouse who's, it would be like having a bucket you're trying to fill with water and a big gaping hole in the bottom of it. And that would drive me crazy. And how you resolve that if you're already in a relationship like that, I haven't a clue. That's far beyond my pay grade.
Right.
I am very fortunate. My wife and I have been married for 33 years, and I am very fortunate in that we are very much on the same financial page, and we didn't have that conversation. Now, it's funny I say that, but on the other hand, she and I were talking the other day, and I forget how this came up, but she said to me that while we were dating, I had said to her that she needed to save 50% of her salary. I don't remember saying that, but I'm sure I did. It is the kind of romantic thing I would have said on a date. But Jane is my wife. Jane is very, very much on the same page. Not so much in investing, because that wasn't the way she was raised or her experience, but very much on the same page in terms of being thrifty
Yep.
and frugal. And in fact, if, and this is a wonderful problem to have, but I have to encourage her to spend money, particularly on herself, and particularly now that we are so financially comfortable, because she is just very reluctant to. I mean, it's just hard. It's hardwired into her to be frugal. But I would much rather have a wife that I have to encourage to spend money than one that I'm trying to rein in.
Right. And just to be clear, I've heard the exact opposite story too, where the wife is the one being a frugal and saving, and the
Oh,
husband's buying monster trucks and
absolutely,
guns and everything
absolutely.
else. Yeah.
Yeah, absolutely. It cuts both ways. It just, yeah, no question about that.
So I think it's interesting. So as a couple, how do you guys talk about your investment and money? Is it over a dinner? Are you meeting every week and talking about where your money is? Like, or does everyone just have the same account and each of you can log in and see what's going on? Like, is there a plan?
Well, I don't think we've ever formalized what we do. I mean, basically, in our household, because it's my area of interest, I handle all of our investments, and Jane handles all of our day-to-day spending. So she pays all of the bills. And not to be morbid, but one of the things that I'm keenly aware of is that she will very likely outlive me. And I have seen too often the spouse, male or female, but the spouse who is not the one handling the investments. In fact, I have a very good friend of mine, unfortunately passed away last year, and at a young age, he was 57 and died very suddenly. And his widow, of course, says, Joe didn't know he was going to die. And Joe never really sat down with her to explain what they were invested in and why.
Hmm.
And so this poor woman is dealing with the enormous grief of losing her husband, and they had a wonderful marriage. The enormous grief of losing her husband at the same time of trying to get a handle on how she's going to live and what they have. So one of the things that Jane and I do on a fairly regular basis is we will sit down and I will go through what we own and why we own it and where it is. And one of the beauties, by the way, of index investing is that not only is it powerful and more powerful than anything else and easier than anything else, but it is simpler than anything else. So our portfolio is really the soul of simplicity. We only own two funds. We own VTSAX, which is the total stock market index fund, and we own a bond fund. And that's it. Now, we own them in different places. We own them in our IRA and in our taxable account and in our Roth IRAs and what have you. But there are only two investments that we own. So it is one of the advantages of investing the way that I recommend is that it is very, very simple to understand, even for the spouse who is not particularly interested in the subject. But it is critical that you both know what's going on. And in fact, she and I were talking because we have done a much better job of getting Jane up to speed on our investments than getting me up to speed on our bills.
Yep.
That's not a failure on her part. That's a failure on the student's part. That is to say, my part, because I just need to sit down because if God forbid something were to happen to her, within a month I'd be in default on all of our bills.
Now, when I was a W-2 worker and had a regular job, I did put money into my company's 401k account, and my money went to a mutual fund. How is that different from an index fund? Are those two different things?
Well, yeah, yes and no. I mean, first of all, a 401k is a tax-advantaged investment bucket is the way to think of it, right? It's not an investment itself. It is a bucket that you would hold an investment in. So a 401k or a 403b, which are employer-sponsored buckets, you have IRAs, which are buckets that you own personally, and then mutual funds or other kinds of investments are the things that you put into the bucket. So an index fund is a mutual fund. So all index funds are mutual funds, but of course not all mutual funds are index funds. So a mutual fund is simply a pool of money from a lot of different investors that is then invested in accordance with the structure that the fund has created, with the objectives that the fund has. So any given fund will say, this is a stock fund, and we're going to invest in large companies, what's called large cap or small cap or whatever it is. Or we're an index, we're a mutual fund, and we're going to invest in the total stock market, which is what VTSAX does. Or we're an index fund that's going to invest in the S&P 500, which are the 500 largest companies in the market. So a mutual fund, and mutual funds can invest in things beyond stocks. They can invest in bonds. They can invest in real estate investment trusts. They can invest in precious metals. So a mutual fund is simply a pool of money that will invest in a certain kind of an asset. And an index fund so one of those kinds of assets could be stocks, for instance. And then a mutual fund can either be actively managed, which is highly paid managers trying to pick the best stocks for that mutual fund, or it can be an index, which is simply buys every stock in the selected index it's going to follow. Does that make sense?
Totally makes sense, yeah.
Oh.
Kind of talking about family still. Now, you and your wife had a daughter, so I have two questions about that. Was your daughter expensive? And have you kind of given all this information to her so she can start early on her own financial independence?
Well, let me start with the second one first, because my daughter, who is about to turn 24, would say that and would say correctly that I turned the fire hose on her much too young. And unfortunately, in the process of doing that, I think I kind of turned her off. And of course, I did it with the best of intentions, because in this complex world that we live in, money is an incredibly important tool. And in fact, it is the most powerful tool that is available to us. And if you understand money and you understand how to use it, you understand not to get into debt, you understand how to invest, your life will be immeasurably better, and your options available to you will be far broadened. If you don't learn how to understand money, you'll become its slave, and you'll slip into debt, because there's this huge marketing machine out there that is designed to sell you crap that you don't really need. My goodness, the idea that you can finance this allows them to sell it more aggressively at even higher prices. So if you don't learn how to handle money, money will handle you, and to your detriment. So because I believe that so strongly, and I want the very best for my daughter, I probably pushed too hard too soon. And we're kind of recovering from that. So it is getting better.
So it was having a kid expensive, like did that, yeah.
First of all, when Jessica came along, we were financially independent. I don't think I really understood that we were financially independent, by the way. It was I mentioned the longest I ever stepped away from a job was for 5 years, and she was born in that 5-year period. That's the kind of thing that happens when you're not employed. You have too much spare time. But what I discovered, just as a little sidebar, in that 5 years is something about 3 years into it, I noticed something really interesting, that we were paying all of our bills, as always, and our net worth kept growing. And being financially independent was not my goal. I didn't even realize it was a goal. But I did realize when suddenly I noticed that our net worth was growing even while we were paying all of our bills, it occurred to me that something really amazing had happened. So when Jessica came along, we were already financially independent. And then because I enjoyed working for the most part, after that 5-year period, I went back to work. So I had an income coming in as well. So we were in comfortable financial shape. So I don't remember her being expensive, but that might have been because we were so far beyond living paycheck to paycheck. Certainly, college was expensive, but that's the only thing that I remember looking at and saying, "Oh my goodness, this is expensive."
The question I have now is it's about the stock market. I, I I need a bit of an education, you know. So we've been talking about index funds, and that's where this company will just buy pieces of all these different companies, and that's how they invest. But you know, the idea of Wall Street and the stock market, I have some questions about that. I want to know how the stock market works, as you traditionally see when you turn on like some business channel on TV and they're talking about the stock market. I want to understand that. So here's how I understand it. A company like Apple or something, they sell stock. They say, we're going to sell part of our company and it's this much, and then people buy that, and then the company gets investment. They take that money and they can then invest in computers and workers, and they can grow its business. But once they sell that stock, then the stock is just traded among other people. And if I understand correctly, Apple then doesn't get any money when those stocks get traded among people. Is that correct?
That's correct.
So why do companies care if their stock prices go up or down if they're not getting any benefit? Like once they sell off their stock, why do they care where the price is?
Well, I think they care because if they ever want to issue stock again, if they want to make acquisitions, they'll frequently use their stock to make acquisitions. So if Apple, using your example, comes across a new tech startup that comes on the market and is, whether it's a publicly traded company or is still privately held, Apple says, gee, that would really fit well with our portfolio, and they want to buy that company. Well, one of the ways they can buy it is by trading their stock for it. And obviously, the more valuable their stock is, the less number of shares they need to trade to acquire whatever company they want, or to give to the founders if it's still a privately held company. So there are those kinds of motivations. But basically, you're right. Unless Apple were to, or any other company were to issue new stock, which they could do, companies tend not to want to do that because that dilutes the current owners, right? Because if you own however many shares of Apple you own whatever percentage of Apple that number of shares represents. And if Apple suddenly increases the number of shares, then your ownership decreases. So it's usually not looked upon favorably when companies issue new stock into the market. And they usually do it when they're in financial trouble and they're trying to raise money. But yeah, basically, once they issue the stock initially, like when a company goes public, they issue the stock initially, and then they get the money from that. And that's frequently a way, by the way, that founders of a company can cash out and cash their equity out and what have you, is by going public or by selling it on the private market. But yeah, once the stock is trading, those trades don't put any money in Apple's pocket or in IBM's pocket or anybody else. Yeah.
So really, it's just a way for people to keep score almost, and for some reason, I guess companies just buy into that scorekeeping.
Well, they buy into the scorekeeping, but the other thing to understand is that when you own stock, you're an owner of that company, and the company has a fiscal responsibility to act in the best interests of its owners, and whether it's a private company or a public company. So Apple has an obligation Apple and every company has an obligation to many different stakeholders, as they're now called, but owners are certainly stakeholders. So you want your owners to benefit by virtue of your company.
Here's a question I've always wanted to know, and I get to ask it now because I've always been confused by this. It seems like back in the old days, I imagine like it's 40s and 50s, people would buy stocks, and it seemed like it was a popular thing for companies every quarter or every year to then give some money back to people who own the stock. A dividend, yes.
Okay.
And it seems like these days, stocks, most most, current companies don't do that. So really, if I buy stock in a company, I just own the actual stock, and the only way I actually get money is if I then sell that stock higher than I bought it. So it doesn't really make sense for me to hold on to it long term unless I just think over time the money's going to go up. Why don't companies do that anymore where I get a little piece of the action every year?
Well, first of all, some companies do. A lot of companies do. In fact, Apple, to use your example, recently started paying dividends. So, and if you look at VTSAX, the total stock market index fund, the dividend on that, which is to say the dividend on the entire stock market, is about 2%. So not all companies pay dividends, but some still do. Now, you are correct. The dividends in the old days were a lot more popular than they are today. And there are a couple of reasons for that, some of which have to do with taxes. But there are many ways that a company can create value for the shareholder or return value to the shareholder. And dividends are only one of those ways. And in some respects, they're not even the most attractive way in my point of view. Just off the top of my head, for instance, a company, instead of paying a dividend, could buy back more of their shares. They could buy their own shares back. And that has the net effect. Remember, we were talking earlier that if they issue more shares, it dilutes my ownership. Well, if I own Apple and Apple buys back some of their shares, now the number of shares I have is suddenly a greater percentage of the total of Apple. So I own more of Apple. So that's a way that delivers more value to me. They could take their money and instead of paying it out in dividends, they could acquire a company. We're just talking that Apple might want to acquire companies. Well, you need capital to do that. So instead of paying that capital out, you could spend it to acquire companies. And in fact, one of the things basically speaking, the investment world tends to divide stocks, and this is not a hard and fast division, but there are growth stocks and there are value stocks. And so growth stocks tend to be young, rapidly growing companies. And most investors say, I don't want that company, if I own it, to be paying me dividends out of their profits. I want them to be plowing those profits back into growing the company because there is more potential in growing that company. Now, if you get a larger, older, more established company that doesn't have great growth potential, then they may not have opportunities to reinvest that money in growing their business. And so they are more inclined to pay out a dividend as a way of rewarding their shareholders for holding it. Tobacco companies are a great example of that. So, there's no great technology to be had in manufacturing cigarettes. Cigarettes are an incredibly high profit product and you can crank them out very cheaply, but there's really no way to grow your cigarette business. So if you're running a cigarette company, you're generating a lot of cash. And the question becomes, what do you do with that cash? Well, there's no real way to make my cigarette company better. I could buy other kinds of companies. I could diversify into other kinds of companies and become a conglomerate. And some companies do exactly that. Sometimes that works. Sometimes it's a disaster because it takes a management that, in our example, knows how to make and sell cigarettes and puts them in charge of making and selling missile parts, which maybe they don't know anything about, and that doesn't turn out so well. Or they can say, you know what, we're going to pay this cash back to our shareholders. And that's one of the reasons that cigarette companies pay a very, very high dividend. So people who are interested in dividend-paying companies can find companies like that. And in fact, there are investors who base their whole strategy on buying companies that pay dividends. I'm not in favor of that because, as I say, there are other ways, in my judgment, sometimes more desirable ways to create value in a company. And I don't want to hold in my portfolio only large, mature companies that have nothing better to do with their money than pay me dividends. but I don't mind getting the dividends.
Right.
So,
Okay. So that totally makes sense. But I guess that's another reason why I like the idea of these index funds because I don't have to think about that. Like that's I guess
you
the
get both.
I mean that's kind of the point of the index fund is that you don't have to worry about who's bringing value, who's not, who's giving dividends, what's going to grow. It's kind of like when we list on eBay, our strategy is just list it and forget it. Like I'll leave
Right.
it on the internet. Someone's eventually going to buy it at the price it's we want, and history has shown that that works if we're patient enough. And the index funds seems the same way. Invest in the index funds, the market goes up or down, but the average seems to be about 4% or so, I guess, profit. Does that make
Well,
sense?
it makes perfect sense.
Yeah.
The average return is considerably more than
Is
4%.
it? Okay.
The 4% rule is just what you can withdraw. But for your portfolio to continue to grow and
Right.
stay ahead of inflation, obviously it has to earn more. Interestingly enough, and I just ran the numbers for a book that I just finished the manuscript on. If I look from 1975 and up until 2000, the end of 2015, the year that we just finished, the overall market returned just shy of 12%. Now, that's amazing, and I don't want to suggest for a moment to anybody listening that they should go out and count on getting a market return of 12% going forward. But it is a pretty remarkable thing. So the stock market can be extremely powerful, but it's also extremely volatile. So as anybody who was invested back in 07, 08, 09 knows, the market can and does take considerable plunges. And one of the basic tenets, by the way, of my investing approach is that when the market corrects, which is the term that Wall Street uses for a drop of 10%, when the market has a bear market, which is Wall Street speak for a drop of 20%, when the market crashes, which is Wall Street speak for 30, 40 plus percent, those are all perfectly normal things. Now, when you turn on the TV or you look at the financial newspaper, every time they make it sound like the world is ending.
It's like a zombie apocalypse about to
It's like
happen.
the zombie
Yeah.
apocalypse has come, exactly. And one of the key things you need to understand to prosper in the market is that this is absolutely normal. It is the price you have to pay to get the long-term benefits, and you should only be investing for the long term. And what you do when the stock market plunges is absolutely nothing. Or if you're able to, you invest even more because that's when you're buying things
Yeah.
on sale. The other point I wanted to make is I want to talk a little bit real quickly about why indexing works so quickly, because you went through some of the characteristics. One of the other characteristics is when you index, you don't even have to worry which companies are going to succeed and which companies are going to fail, because the index is what I like to call self-cleansing. And here's what I mean. So when you buy the index, when you buy, let's say the S&P 5, well, let's take the total stock market because that's the one I like better. So when you buy VTSAX, which is Vanguard's total stock market index fund, you are buying virtually every publicly traded company in the U.S. Now, not all of them are going to succeed. Some of them are going to fail. What happens when they fail? Well, your investment in them goes to zero or very close to zero, and they fall off the indexing. So they get cleansed off the index. So they get blown away, and they get replaced by some new upcoming aggressive company. Now, some of those companies in the index are going to succeed, and some of them are going to succeed in spectacular fashion. So the ones that fail can cost you a maximum of 100% of your money. The ones that can succeed can make you 100% of your money, or 200, or 300, or 1,000, or 10,000% on your money. So there is a bias on the upside when you're investing in every stock in the market. You know some are going to fail. You have no way of predicting which they're going to be because some of them will turn around before they fail and become great successes. But those that fail just drift away. They get replaced by new blood. And meanwhile, those that succeed can succeed in a fashion far beyond 100%. So that's self-cleansing, and that's one of the reasons that the stock market, over history, relentlessly tends to rise understanding that periodically it takes these plunges that are just simply part of the process. So the best thing to do is to invest as often and as frequently as you can and ignore it. Just let it ride. Look at it 30 years from now when you're ready to use it. An interesting thing about that is my daughter once said to me when she came back from college and I was trying to bring this subject up again, she stopped me and she said, Dad, I know this is important. I appreciate it. I just don't want to have to think about investing in money all the time.
Yep.
And that was an epiphany for me. And it's one of the things that this epiphany is one of the things that drives me when I'm writing on my blog. I'm the aberration. I'm the odd one out. People like me who love this investing stuff and like to think about it and play with it, we're the odd ones out. Most people have better things to do with their time.
Yep.
They have businesses to build, like you and Ryan have. They have diseases to cure. They have bridges to build, whatever, and they understand, as hopefully my daughter does, and everybody listening to us, that they have to understand enough about money to make it their servant rather than their master. But it's not where they want to spend most of their time.
Right.
And what I try to emphasize on my blog is that you just need to get a couple of things right on the money side to be really successful. And the irony is that the less you pay attention to your investments, if you get the right investments, if you invest in index funds and just invest for the long term, ignore the drops, let it ride, the less you look at it, the better. So my daughter is actually positioned psychologically, if she does these couple of things right, to prosper much better than the person who makes it a hobby and obsesses about it, because they are much more likely to do stupid things when the market gets scary, or to do stupid things when they come across some new investment philosophy that they think might outperform the index.
I mean, and I think that's why I wanted to go back real quick, because we're kind of in the tail end of our interview here. I want to talk about this company, Vanguard, that I mentioned. Neither of us work for Vanguard. This isn't an advertisement, but it's an important company because it's the first one that came up with this idea of index funds. And you even mentioned the guy that started it, this guy named Vogel, who it broke the pattern of a Wall Street and came up with this investment vehicle for normal people. And I guess if you could talk about Vanguard and why it's different, and why would a man start a business that didn't fleece people? That is kind of what people think Wall Street does.
Well, that last part of your question is really interesting. So, why Jack Bogle chose the path that he chose, as opposed to the path that the vast majority of people in the investment world choose, is something I can't begin to fathom, but it does make him a saint. It makes him a fiscal saint and a personal hero.
And just real quick, I mean, people of my age, the way I would talk about it is he was like the punk rock guy of the investment world, back when everyone was just trying to again kind of fleece people. He was trying to make something that seemed true and real. It's like a real investment vehicle that would actually make people money over time.
Well, here's the thing. So if you look at Fidelity, which is a big investment company, the guy who founded Fidelity, and I'm not going to mention names, but the guy who founded Fidelity has become a multi-billionaire. Now, Jack Bogle founded Vanguard, which is as we sit here today, is the single most successful investment company in the world. And Jack Bogle is probably worth, $100-200 million, which is a lot of money. But when you created the largest, most successful investment firm in the world, it's peanuts. I mean, Jack Bogle, had he put his own needs ahead of his investors, would be worth multiple billions of dollars. He didn't do that. Now, he did fine. So what Jack Bogle did, and what makes Vanguard so unique, is Bogle decided to create an investment company that basically put the needs of the investors first, as opposed to the needs of the company first. And the way he did that is he structured it in a very different fashion than any other investment company. So, a typical investment company, and actually a typical company of any kind, is basically structured where you have people that own the company and they sell a product to their customers. And they want to, presumably, sell a good product. Not always, some companies don't do this, but let's look at the good companies. So, a good company, let's take Apple as an example. So, I think most people would agree Apple's a good company. So, Apple has owners, shareholders now, and before that, the people who started it, they have owners, and Apple wants to make those owners wealthier. And as investors in index funds, of course, we own Apple, we applaud that. Apple does that by creating the best possible products they can, because then people will buy them. And to a certain degree, the needs of the owner are fulfilled to the degree that Apple is able to satisfy the needs and the desires of the customers. Does that make sense?
Yep.
Okay, now an investment company, it's a little bit different, because an investment company is going to make money based on the fees they charge their investors, their customers. And of course, the more fees they charge as owners, the more money they make as owners. But of course, the less money we as investors make. Now, there's a limit to how much they can charge, because if they charge too much, investors drift away. But because Wall Street has been masterful at making this all mysterious to the average investor, the fees are also mysterious, and people tend not to notice them, and they get away with charging incredible fees, some companies. Now, Jack Bogle comes along, and he creates Vanguard, and the ownership of Vanguard is owned by the people that invest in its mutual funds. So when I own VTSAX, I am at the same time an owner in Vanguard itself. So now Vanguard has no motivation to raise fees on me, because they would raise fees, they would make profits, they would put those profits back to the owners, which would be me. It's a circle that doesn't make any sense and also creates a taxable event. So Vanguard has the motivation to keep fees as low as possible. So Vanguard just charges fees enough to keep their company growing, to keep it staffed, and to attract talent and what have you. So Vanguard has a bias towards lower and lower fees, where every other investment company has a bias towards making the fees as high as they can get away with. And the net result of that is that the Vanguard and its investors, their needs and goals are exactly the same. They are aligned. And that's not true of any other investment company out there. Now, as I mentioned, in the investment community in general, tried to strangle index investing in the crib, because they recognized immediately that this was going to be damaging to their model. And they didn't succeed. They almost succeeded, but they didn't. And indexing has become extraordinarily popular because it is so powerful and it costs less money. So Vanguard has forced some of these other companies to create their own low-cost index funds. And that's a good thing. But I am always going to default to investing with Vanguard, because it is part of the Vanguard culture. Whereas in every other investment company, they've been dragged kicking and screaming to it, and their heart really isn't into it. Now, where this comes into play for some of our listeners is if they have 401k plans or 403b plans, Vanguard might not be an option. But they might see an index fund, either a total stock market index fund or an S&P 500 index fund from another investment company. And assuming that it's low cost, and most of them are now to be competitive, there's nothing wrong with investing in those, and those are a good choice within your 401k. But if you have the option to go with Vanguard, I'd rather go with the company who is structurally on my side, as opposed to the company that is only doing it because competitively they don't have much choice.
Now, I actually told a bit of a lie earlier, saying we didn't invest in the stock market at all. But actually, this year, I put in a little bit of money in an IRA just to kind of get started. And I did it through a Vanguard. And I had to open my account, and I had to actually call them because I had a question. And I got the customer rep, and he actually put me on hold. And when he put me on hold, it was silence. It was very strange. Because normally when you do through a company, there's a music or there's some kind of recorded, it's message, advertisement. And when the guy came back on, I asked him why there wasn't any music. And he said that Vanguard chooses not to pay for the music that has to get played during that time because they're so frugal and cheap. And I was like, wow, that's really incredible.
I didn't know that. Jack Bogle himself has a reputation for being very, very frugal, so he's very much one of us, both in your Scavenger audience
Right.
and in our FI audience. So that doesn't entirely surprise me. I never really noticed that there's silence when you're on hold at Vanguard. But one of my great pet peeves in life is when you go on hold and they play this obnoxious music.
So bad.
Because if I'm on hold, I want to be doing other things. And what's even worse is these companies who play ads for themselves.
Right. Oh my God.
I want to reach out and strangle them.
Yeah. Right. And so the only reason why I really want to bring up specifically this company Vanguard is, they're pioneering ways of doing this. So if anyone is thinking about investing, this company is the one that all the financial independence bloggers kind of talk about, and it only makes sense in the illicit and it's forget it sense. I mean, that's why we would invest in this company or through this company, is because we could just invest our money and then just not think about it anymore, which is, like you were saying earlier, that's the way I want to invest, because I have things I want to do. I don't want to be thinking about this every day. And so that's the way it would make sense for me.
I agree. I'm a huge, huge Vanguard fan, and I don't work for them, and I don't. And unfortunately, when you run a blog, one of the ways that you can generate money to pay the costs is affiliate partnerships, where you talk about a company or a product, and if your readers click on it, they wind up buying. Your blog gets a small commission, and I do that. I have some affiliate partners, and I'm very selective, and I only put up companies that I really genuinely like. But Vanguard, unfortunately for me, doesn't have any affiliate partnership available. And of course, there's no company I talk about more on my blog than Vanguard, but I have absolutely no financial incentive to do it, and I wish I did.
Right.
In fact, FinCon is a convention for financial bloggers, and Vanguard usually has a little booth there, and I've talked to the Vanguard reps. And one time I was talking to the woman there, and she said they were kind of thinking about introducing one of these affiliate programs. And she asked, "What do I think?" And I said, "Well, I have two opinions on that. I mean, from a very selfish point of view, I would love it because I would immediately sign up to be an affiliate, and I talk about you guys all the time. But as an investor in Vanguard, it runs counter to the ethic of Vanguard, which is this incredibly frugal, low-cost, save every dime you can, because every dime you save goes back into the pockets of your investors." So I said, I would personally love you to have an affiliate program, but my recommendation is that you don't do it.
Yeah.
So far they haven't done it, and I don't see it coming. Yep. So.
Now, we were talking earlier, so Vanguard started in 1976, I think you said.
75, 76, somewhere in there, yeah.
And so we're talking 30 years later. No, 40 years.
40
later.
years.
And it is true. I mean, it's actually, there's been articles done about it where Vanguard's become a fairly large part of the investing world. I mean, it's no longer kind of a hidden a secret. And it seems to make so much sense. So I see this kind of talked about in forums. Why isn't everyone just indexing? Why isn't it taking over half the market? Like, why would anyone still invest in hedge funds if index beats market?
That's a really interesting question, and I have a post on the bashing of index funds and what have you. And every now and again, I'll get a question on my blog, or I'll see it asked in other forums where people will say, well, if indexing takes over in the investment world and everybody's indexing, is the market really still going to work the way markets are supposed to work? And I don't know the answer to that question, but I don't worry about it because it's not going to happen. And the reason it's not going to happen is that there is so much, there are a couple of things. There is so much money to be made by Wall Street by convincing people that they can pick individual stocks, or that there are managers who can outperform the market that they can invest in. There's so much money to be made in doing that. There is so much marketing effort that is behind that concept. And it is so relentless that if you pick up a financial magazine, whether it's Kiplinger's or Money Magazine, or you go on to any financial website, or you turn on the TV, you will find all of these individual managers and newsletter writers touting that they can outperform the market and they can pick stocks and that you should invest with them. You'll find, companies that will say, we've got our funds and they've outperformed. Well, part of the reason they do that, by the way, is they select a very narrow time frame to look at where, in fact, they outperform, just like the bet we were talking about that Warren Buffett has with the hedge fund guys. Well, in the first couple of years, the hedge funds did beat the market. It's hard to do over time. So if you selected those first couple of years, you'd say, see, this proves hedge funds are better. Well, it proves no such thing. And then, of course, what these companies do is when they get funds that underperform, that perform badly, they just quietly close those. They roll the money into one of their better investing funds so they can keep saying, all of our funds are outperformers. And then they keep launching all the time new funds. And then they just quietly close the underperformers. And so it's kind of a rigged game in that sense. But the other side of that coin, so you've got this enormous financial incentive to keep beating the drum that this is how you should invest. The other side of that coin is that it is very, very hard for people to accept that they can't outperform. Like I said, it took me 10, 15 years after I learned about index funds to accept that. Well, I'm embarrassed to admit that. Well, but I admit it not to say I'm a pretty bright guy, I think, by and large. But it is so counterintuitive, I think especially for smart people. It is so counterintuitive to accept that an unmanaged index is going to do better than you're going to do, as smart as you are, as clever as you are, either picking individual stocks yourself or identifying the managers that can do it.
I mean, I had a friend that worked on Wall Street, and part of his job was cold calling, picking up the phone. He's got contacts or people who say might be interested, so he's calling them, just asking them for money and convincing them that they're going to make more money. And what he always told me was a lot of it, too, is just a gambler's mentality. I mean, I'm not talking about you, of course, but I know that in the wider market, that the gambler's mentality is a big thing. I mean, people don't want to think about, well, I'll just put some money and make 7% a year, 4% or whatever. I want to make 30%. I want to double my money in 12 months. That's what I want.
It's incredibly seductive. I mentioned earlier that I actually reached financial independence with individual stocks and picking mutual funds. And when you pick a stock and you watch it ramp up and work, it is an incredible it's an incredible high. I mean, it's I don't do drugs, but I imagine it's like snorting cocaine.
Yeah.
It is incredibly seductive. It's incredibly addictive. And I'll make a small confession here. I still fool around with individual stocks every now and again. It's a tiny fraction of our net worth, and it's a stupid, silly thing to do. And I never talk about which stocks they are because the truth is that nobody should think for a moment that I can do this successfully. And I own two at the moment. They're both deeply underwater, by the way, so proving my point. But it is incredibly seductive when you pick a stock that works. So if you have somebody who, and this is one of the reasons it took me so long to accept indexing, is because, let's face it, I became financially independent picking stocks and mutual fund managers. I had a pretty successful track record. and plus I had this incredible high of when it worked, and you tend to discount the times when it doesn't work. It's like when you go to Las Vegas. I can't count the number of times. I used to go to Las Vegas routinely for business on conventions and things. It was amazing to me. I mean, I'd go with my business colleagues, and they'd make a couple bucks at the craft table or something, and they'd come back chortling about how they'd bested Las Vegas, conveniently forgetting all the times that they'd lost.
Yeah.
And I'd listen to these people talk about how, they outwit the casinos. And I'd look at this multi-billion-dollar casino.
I mean, it's like,
and I'd say, right.
no one's outbidding them, yeah.
You're going to walk away ahead of the game. Well, you're smarter and better looking than I am, so what do I have to say?
So when I'm reading these financial independent blogs, again, like it's Mr. Money, A Mustache, and others, there's a common theme, and you kind of talked about it when you interviewed us. Often it's someone, and maybe it's a two-income family, where they're making over $100,000 every a year. Young professional people, they're doing very well, and and it's smart. While they're making that kind of money, might as well just save and buy their independence. Is there a strategy for other people though that are making $35,000 every a year? I mean, or does it really only make sense if you're earning a high income?
I actually have a post on this very subject, and it's in my stock series. I forget which number it is, but the title of it is something to the effect of, "Can everybody really retire a millionaire?" And one of the things that I talk about in there is that retiring a millionaire per se is $1 million is a fairly random number, and it's appealing because it's a big number and it's a round number. But at the beginning of this conversation, you alluded to the fact that you needed $24,000 a year to meet your needs, and you only need $600,000 to with the 4% rule to meet those needs. You don't need $1 million. So anybody can do this. It depends simply on how much do you need. If you need, and of course your needs can be adjusted, right? So our needs can be flexible. But if you need $100,000 to live on, you need $2.5 million invested. If you only need $24,000 a year, you only need $600,000. So if you are a two-income couple and you're making $150,000 together, chances are you're going to ease into a lifestyle that requires a lot more money than somebody who's making $30,000 or $40,000. So you have more money to invest, but on the other hand, you're probably going to need more money to support a lifestyle you've saddled yourself with. Whereas the person starting with less money probably needs less money, and so the amount of money they need to accumulate is less. And proportionally, they're probably going to be pretty much the same. So I say to people all the time, how much money you earn is not a predictor of whether or not you are going to be financially independent. It's how much money you need to live on and how much money you can save that are going to determine those things. So, for instance, I have a very good friend of mine who has never made more than $40,000 a year in his life. He's put his two boys through college, and he is financially independent. On the other side of the coin, I mentioned I spent a brief time in the financial business, and at one point, this is back in the 90s, I was having lunch with a former colleague of mine, and he had stayed in the financial business, and this was just before Christmas, and he had gotten his annual bonus, which was $800,000. And you want to know what we talked about at lunch?
What?
We talked about how you can't live on just $800,000 a year. And when I sat there and I listened to Ken talk about his expenses and his lifestyle, he was absolutely right. The lifestyle that Ken had was not supportable on $800,000 a year. So Ken, unless he changes something, in spite of the fact of making an enormous amount of money, is never going to be financially independent. Most people listening to this, I would guess, are probably saying to themselves, You pay me $800,000 one year, I'm done. I'm finished.
Yeah.
That's all I am ever going to need. But for Ken, it wasn't enough. And he's probably never going to be financially independent. Whereas for my other friend who never made more than 40 is. So it's important for people listening to this to understand that a lot of it depends on your needs and your lifestyle. A lot of it depends on your savings rate. Very little of it depends on how much you're earning. Now, obviously, if you don't succumb to lifestyle inflation, and at the same time you wind up making $150,000, well, and you only need, say, $600,000 to retire, well, obviously you're going to get there more easily and more quickly than somebody who's making less money. But that's not necessarily the determining factor, and there's nothing in this that should, in my mind, discourage somebody making a modest income from going for it.
Really, because it is just kind of a numbers game. I mean, that's what we always talk about when we sell it on eBay. It's just a numbers game. You know, how much you can list, how much things sell for, you know, how much money we need to live every month. It's just an equation that each of us have to work out. It's for ourselves. And it'd be the same way with saving up enough to invest to generate enough interest to live on. If $600,000 is its number in order to live on $24,000 every a year, then you just have to think, how do I make $600,000? You know, do I sock away $30,000 every year? You know, how do I do that? And, you know, I mean, that kind of seems it's really just a numbers game. There's no a mystery to it.
Exactly. There is no mystery to it, and money is relative.
Right.
So how much money you need is going to vary from person to person. And I do case studies on my blog, and one of my favorite case studies is a good friend of mine. It's the title of this case study is something along the lines of what it looks like when everything financial goes wrong. And it was actually a case study that based on a personal friend of mine, and I asked him if he would be willing to share his story. But he's a guy a couple years older than I am, and he used to be a client of mine, actually, and for a variety of reasons, Tom reached the age of 62, flat broke, divorced, having his house repossessed. Everything financially had come apart for Tom. And yet Tom is one of the happiest people that I know. Mm. And Tom lives on Social Security, which he took at 62, which is not optimal to take it. You know, financially, you're better served by waiting a little bit, but Tom didn't have the option. Tom lost his house, but, you know, he lost everything, but he has a part-time job now that he loves, and it gets him outside, and he's healthier for it, and he's living with his beautiful Swedish girlfriend, and life's not always about just the money. You know, a lot of it's about attitude and flexibility.
Just to kind of end this, or to kind of, you know, round this out, you know, up until now, you know, basically what we're taught in school, what you see in popular culture, we're bombarded with all the advertisements. You know, the idea is you go to school, you work till you're 65, you've hopefully saved up enough retirement, you get Social Security and a Medicare, and then you retire. You know, that's kind of like the story we've all been taught. Do you think with now the internet and there's this kind of like burgeoning financial independence, its movement, and just the reality of the economy now, where some people are getting to 65 and there is no retirement, do you think that we're going to see a big change in how all this works?
Well, I don't know that we're going to see a big change. I think that, first of all, I don't see it becoming a large and major trend. As we talked about earlier in this conversation, people like you and me and our listeners and in this FI movement, we're very much the odd ones out. Most people don't think this way. There is this enormous marketing machine that is out there daily convincing people they need a bigger house. They need new appliances in that house. They need new furniture. They need to be buying new cars. They need to be on this track where it's spend, borrow, 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 work. And it's just for the same reason that people are not all going to become index investors. the marketing forces to keep people on that consumerist track are just enormously powerful. What is different, though, from when I was coming up is that we do have this thing called the internet, and there is this source of information, and people have access to the concept in a way that I didn't. As we talked about in the beginning, I was wandering in the wilderness, not really knowing what I was doing, and kind of being surprised when I sort of stumbled across this line to being financially independent. Now, for those people who are interested and are willing to consider the idea, there's wonderful paths that have been laid out for them in my blog and other blogs. But if you look at somebody like Mr. Money Mustache, when he gets picked up in the mainstream media in an article talking about the possibility of doing this, if you look at the comments, the hostility and anger about it, it's breathtaking. So not only are people, it's not just as if people are saying, well, that's not for me. I want to keep buying my new cars. But there's something, because it's so, the propaganda has been so effective that people are hostile to the idea that there's a different way to do it. So I don't see any major change coming, but I do think that for that minority of people who are willing to consider alternatives, who are willing to say, you know what, maybe I don't want to work in this job for the next 40 years, or even people are willing to say, I really like as I did, I really like my work, I like my job, but I don't want to be a slave to it. I want to have flexibility. Well, it's much easier for those people who are inclined to do something like this to do it today, easier than ever before.
I have seen that, like in the comments of "Is Mr. Money a Mustache," where people get offended by what he's proposing, like it's very interesting. I guess maybe because basically, in what you guys talk about, it's kind of saying the people that do buy new cars and they get a lot of debt, you're basically saying they're doing something wrong, or that's how they read it, and that's where the offense comes in, I guess.
Yeah, maybe that's it. And, and it does run so counter to, the marketing machine that is out there beating the consumerist drum all the time, that it's a hard thing for people to accept. I have to say the hostility towards it does amaze me. I would not have predicted that. I would have predicted that people would discount it and they'd say, well, that this is not real, or this is some sort of scam, or
exactly.
Whatever.
Yeah.
I would have anticipated that.
Yeah.
But the hostility towards the idea that it's possible is just. I mean, sometimes I can only read so many of these comments before I feel like I need a shower. But a lot of them, and Money Mustache is in the mainstream more often than most because he's so extraordinarily well known and popular. And I happen to know him personally. And I'll read these comments that say, well, he's just lying. This isn't possible. It's not true. Well, I know the man. I mean, I know it's possible. I know his story firsthand. I'm sometimes I'm tempted, but I'm never going to go on those and argue the point because I'm not going to convince anybody.
Yeah.
But it is possible. I know countless numbers of people who have done it. I mean, they comment on my blog routinely, and sometimes, and this is wonderful for me to hear, they give me some credit for having helped them get there.
Yeah, I mean, I think the same thing happens in our scavenging world. People will come on our blog and seem incredulous that anyone could make a living finding things out in the wild, just basically people trash things, people that are donating that you can make a living. But we try and, but it really is a numbers game. It's all breaking it all down. It's for people and just helping everyone figure out their own equation. How much do you need to make every month? It's just a number. Is it $1,000? Is it $100,000? And then how do you make that kind of cash? And that's really all it is. And then
it's not complicated,
right? Now,
I imagine, Jay, if you and Ryan ever get interviewed in some mainstream media a format where your lifestyle and ideas are exposed to a wide range of people, I can imagine there's going to be a lot of hostility, and some of it will probably be along the lines of, "How dare you buy something for $1 and sell it for $100?"
Exactly right.
I
Right.
mean, people are not entirely rational,
Right.
and so I've never been asked by any large media venue to be interviewed or what have you, and I don't particularly want to. I don't know if I would turn it down, but I do know that it would direct a lot of anger and bitterness and bile towards me that I don't need in my life. Nobody's asking, so I don't have to worry about it.
Well, Jim, it's been great talking to you. Can we just end with, we're going to, in the blog post here, we'll put a bunch of links to the posts on your blog that you talked about. But did you want to talk about some of the projects you're working on? And I know there's that big trip down to South America that you're taking.
Well, I'll talk real quickly about a couple of things. The what you just mentioned is what we call a Chautauqua, and we did the first one in 2013, and then we did one in 2014, and then last fall we did two back to back. And what the Chautauqua is we take a group of people down to Ecuador, where Cheryl, who it's her company that does this Above the Clouds retreats. I sort of helped her create the idea and concept, and we have four bloggers that go down as speakers, and I'm one of them. And so it tends to be readers of one or more of the blogs who sign up for these things, and we go down and we each of the speakers gets up and talks for a couple of hours on one of the days, and then we all hang out together and we explore Ecuador together, and we do one-on-one sessions with attendees who choose us for their one-on-one session. The most interesting thing, and we alluded to this earlier, is without exception, everybody I've talked to have attended these things, and there's been about 100 people now who's gone through it, because we limit it to no more than 25 attendees at a time so we can really get to know each other during the course of a week. But they all say the single best thing about this is that for a week, they're around people who get it. Because as I said earlier, most people walk in this path. In their day-to-day life, they're surrounded by people who just don't get it and might even be hostile to the idea. So spending a week with people who understand and are on the same path is really seemed, and I would not have predicted that when I first started doing that. So this year, we're going to do two back-to-back. They are sold out. They now sell out so quickly. And the reason we do a second one now is just because the demand is so strong, and we don't want to dilute the experience by having 50 people come to one. So we just do two back-to-back with the same limit. I have the manuscript of my book is done. Now I have to figure out how to get it published, and it is based on what I write about in the blog and my stock series. And then the most fun thing is recently I just put up a YouTube clip that was produced by two filmmakers that I met who attended last year's Chautauqua, Joan and Brian. And it is based, there's the movie called The Gambler, and John Goodman plays a character in it. And at one point in The Gambler, there's this clip that is on YouTube where he is talking about FU money. It's very profane and what have you. And when that movie came out, because I've written a post called Why You Need FU Money, people immediately began sending me that clip. And the moment I saw it, I said, I want to do a version of that. But I didn't know how to make a film. And then I go to Chautauqua. One of the cool things about Chautauqua is you meet really interesting, cool people. And so I go down, I meet Joan and Brian, and it turns out they're filmmakers. So they were excited about doing it. So we just finished it, and I just put it as a post up on my blog on Sunday. And it's a lot of fun. It goes for about a minute and a half. And you get to hear me say the F word and a few others repeatedly, if you're so inclined to hear that. But anyway, it's great fun, and people who've seen it so far have been very kind in their praise. And as I say to everybody who will listen, if I look good in it, and a lot of people tell me I do, trust me when I tell you it's the magic that Joan and Brian brought to the table.
Well, cool.
Producing it. And you can't believe the number of hours, at least I can't. This clip goes for about a minute and a half, and you can't believe the number of hours it took, mostly on their part, to make it happen.
And can you just tell people the name of your blog and where a lot of your work is at?
Sure. My blog is jlcollinsnh.com. JL is my first two initials, Collins, Collins is my last name, and NH stands for New Hampshire because when I was looking for the domain name, every variation of my own name was taken until I added NH on the end of it.
All right, Jim, thank you so much for talking to us today.
Jay, it's been a pleasure. I've enjoyed it, and as we said earlier, the time's flown for me, and I hope our listeners have the same experience.
Cool. All right, I'll see you, Jim. Bye.
Bye-bye.